Welcome to the 3 Edge Week in Review for the week of June 6th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I will be discussing whether, even after the correction that we have witnessed in the U.S. equity market thus far in 2022, the U.S. stock market may still be overvalued. But first, let's just take a brief look at the activity this week. And over the course of the past week plus, equities had been experiencing a bit of a roller coaster ride where they would be up one day and then seem to be down the next in what is often referred to as a market exhibiting sideways chop. However, that seemed to change on Thursday and Friday of this past week. On Thursday, the European Central Bank, the ECB, announced plans to begin to raise interest rates in Europe next month and signaled a distinct possibility of additional and even larger increases in interest rates in the fall. Now, this would end the period of negative interest rates that we've seen in Europe since September of 2019. And on Thursday afternoon, U.S. equities sold off into the close of the market. And then on Friday, the Bureau of Labor Statistics released the Consumer Price Index, the CPI, for May, which showed that U.S. inflation increased to yet a new fresh 40-year high in May. CPI increased by 8.6% year over year. In addition, core CPI, which excludes food and energy, increased by 5.9%. Signs of continuing inflationary pressure could well mean that the Federal Reserve may need to tighten monetary policy more aggressively. So, Steve, let's get started. And thus far, obviously, 2022 has been a difficult year for equities across the globe, and that includes the U.S. equity markets. And certainly, the last couple of days have seemed to see things turn even perhaps more negative. Because as we sat down to do this video, I think the S&P was down somewhere around 17% year to date, and the NASDAQ maybe down to 27%, more or less year to date. And even though equity markets had rebounded from their lows in mid-May, we remained cautious in terms of our exposure. And one important reason for that was we viewed U.S. equities to still be overvalued, right? Even after reaching those lows at the time in May. And certainly over the past 2 days, remaining defensive seems to have proved helpful. But here's the thing. At 3 Edge, we've done an enormous amount of research on the topic of equity market valuation. And our work continues to indicate that the way we measure equity valuations, the U.S. equity market remains overvalued. So I think that could be instructive to explain how our approach here at 3 Edge in terms of analyzing equity valuations is different and why that matters.
So I agree, Fritz. There's a great debate going on now. Some think that with the sell-off, equities are fairly valued. We do not agree. And we take great pride in the fact that unlike some of Wall Street, which we believe takes shortcuts in computing valuation, we take a very deep dive, comprehensive view of what should go into valuing a stock market like the U.S. stock market. When we look at a variety of factors, including normalized earnings, reasonable growth rates looking out into the future, reasonable discount rates or interest rates looking out into the future, reasonable equity risk premiums, and so on, we are able to gauge when we believe the U.S. equity markets are overvalued, fairly valued, or undervalued. Now, this chart will show these measures and this approach being applied to the U.S. stock market going way back in time, all the way back to the late 1800s. And what you'll see is what you would hope to see, that when our approach indicated the market was overvalued, it coincided with great peaks in the stock market. And when our approach concluded that the market was undervalued, it did coincide with great market bottoms. So it's very consistent with what actually happened in the real world. Problem is that despite the drop in equity markets so far this year, we are still among some of the most overvalued markets in history in the U.S. market. We never quite got as overvalued as just before the tech stock bubble burst, based on our measure. But we did get to be considered the second most overvalued market at that time, and that would have been the first day of trading this year in early January. Since then, we've come down, but just a small bit. And as the price has come down, interest rates have gone up, meaning the cost of capital, or the discount rate, has gone up somewhat. We don't just base the discount rate on current rates, but earnings also have done so well, and we don't think there's great upside. So the net of it is, despite the drawdown that we've already had in the U.S. markets this year, we still view the U.S. markets as seriously overvalued.
Excellent. So I know that one important difference in terms of equity market valuation is that we consider the use of the price earnings ratio, which probably the most widely used indicator of equity valuation, to be, I would say, less than optimal. And we think it's more accurate, reliable to focus on the price to sales ratio rather than price to earnings. So perhaps you could explain why this is the case, and then perhaps beyond that, show what the current price to sales ratio of the S&P 500, for example, indicates in terms of trying to understand the current valuations, and importantly, what this could mean for future equity market returns.
So here's a really important point we'd love to express, and that is that the U.S. stock market over its 150-year history shows that while it can become noisy and irrational in the short term, it's very logical in the long term. And the price per share of the U.S. stock market over the last 150 years has grown almost exactly what the sales per share has grown over those 150 years and what the earnings per share has grown over those 150 years. So over any long term, just as logic would suggest, the price of the stock market is very directly tied to the earnings, which are very directly tied to sales. And that makes a lot of sense. The problem is, in the short term, there are times when earnings grow much more quickly or slowly than sales because profit margins fluctuate. Sometimes you have high profit margins, sometimes you have low profit margins. Over time, they all converge and mean revert to a mean. But in the short time, you can be fooled because they can be a lot higher than normal or lower than normal, and you might falsely think that's going to last forever, and it never does. Similarly, when investors get exuberant, the price per share in the short term can accelerate far higher than the underlying fundamentals, or conversely, when investors get very fearful, the price per share could fall more quickly than the underlying fundamentals. So you have these windows of time when they fluctuate, but over the long period of time, they all come back and converge. So let's take a look at the last several years. Let's go back to a chart that shows what has happened with the price per share, the earnings per share, and the sales per share since the last recession, which was the financial crisis of 2008. So on this chart, you're going to see that they are highly diverging. And no one should think that this is a permanent condition, but rather this is ripe for a mean reversion. I'll come back to converge again. So the orange line is the sales per share. And what it shows is that sales have grown nicely since the last recession, but not quite doubling. The gray line shows earnings, and earnings have grown faster than sales, in fact, tripling over that time period, which is great. Now, we think this is temporary because profit margins have been expanding through this whole period, and that's never sustainable over the long term. And we don't think it's sustainable now. But finally, here's the big problem. People say, well, stock market is great because earnings are doing so well. Well, the problem is that while earnings have tripled since the financial crisis, the price per share has gone up 6 times.
Right.
It hit its peak. And so even if earnings were to continue to do decently, there's a lot of convergence that needs to happen, and the price per share just got too high. There are a lot of people who bought stocks who didn't think about valuation. They just thought about riding the trend. The trend was up. And so this is one reason why we think that people should be cautious about stock market valuations.
Excellent. So as equity markets rallied through 2020, 2021, getting back to the profit margins, we saw the profit margin rise dramatically. But now we're in a very, after the first 6 months of this year, it seems like we're in a very different environment. We have high levels of inflation, rising interest rates, tightening central bank monetary policy. So what could this mean for corporate earnings? Could it be a challenging period for corporate earnings and therefore for the equity markets going forward?
Well, we think so. If we look at profit margins today, they are among the highest in the history of the U.S. stock market. In fact, there are only 2 times where profit margins were higher. And show this next chart. And you can see from the chart, profit margins, when they're extraordinarily high or low, they never stay there forever. They revert back to a mean. Right now, profit margins are very high. The other 2 times were, number one, the summer of 1929, which is not great news because that was right before the crash of 29 and the Great Depression. The second time they were a bit higher was March of 1937, which was right after the market recovered from the first dip of the Great Depression, started to do very well. Then all of a sudden, the Fed started to raise interest rates again. And right after this period, the market fell 50% in the second dip of the Great Depression. So these are not great examples of what you'd like to see. And right now, this is the third highest. Problem also, as you alluded to in your question, is that we are worried about stagflation. We've been talking about stagflation for a very long time, over a year. And the real world seems to be supporting our hypothesis that we're getting into a stagflationary period. And stagflation simply means that the stag in stagflation means the economy is starting to slow down. Deflation means inflation keeps going up. And that's exactly what we're seeing now, and even more so in other parts of the world than the US. But stagflation typically squeezes profit margins because the top line, sales, are getting squeezed by slowing growth. Bottom line is getting hurt by inflation rising, and that's squeezing margins. So the stagflation could be the catalyst that brings our abnormally high profit margins back to average. But that would be bad news for the valuation of the stock market as well.
Excellent. So, as always, my final question is based on what we have discussed here today about the U.S. stock market being overvalued by our measures. How should investors think about positioning their portfolios from here?
Well, we certainly think, and based on our latest model research, that it is time not to try to be a hero, but time to stay defensive. We know in the short term, investors can be irrational. News items can come out of the blue. Markets can get surprised, and we could see another rally, either a bear market rally or a bubble. But we think the odds are that we still have a ways down to go because we think the markets are still overvalued, the U.S. market in particular. We think that it's too risky to have too much of an allocation to U.S. stocks. It's much safer to be defensive, to be close to or at the minimums of your range of whatever your risk profiles happen to be or whatever strategy you're in. And to be patient and recognize that by having some dry powder like floating rate treasuries or cash equivalents at ready, if it is true that markets get back to fair value, that will be an excellent time to then deploy that cash into a more favorable market at a more favorable valuation, while other people who held on too long are now forced to sell and liquidate.
Excellent. All right, great. Well, thank you, Steve. Thanks for providing the insight into the current state of the valuations of the U.S. equity market, as well as how to think about equity valuations somewhat differently the way we do here at 3 Edge. So that will do it for Steve and me, but we will be back next week with another edition of the 3 Edge Week in Review. All our videos are available on our 3 Edge YouTube channel. In addition, all our videos and all our written commentaries are always available on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3 Edge, Thanks for listening.